I know a lot of guys talk about S corporation like it's this magic bullet to saving tax, and I mean, it does often save you on tax, but there's a few reasons where it may not work, and it may actually work to your disadvantage. And so the reason the S corporation works is if you're just like a normal LLC, you put your tax return on a Schedule C, you look like this, right? And when you're getting started, that's normally the way to go, right? So the problem is you're basically two people at the same time. You're both the owner of a business, right? And you're the employee. And so 100% of the bottom line of that Schedule C, 100% of your net profit, right, is going to be taxed as if it's a wage. So you're going to pay payroll tax on it, 15.3%. You're going to pay self-employment tax, right? And when you were working for somebody, the employer paid half of that, and then the employee, you, paid the other half. But in your case, if you're running a business as a sole prop, you're both sides of that equation. And so you got to pay, it's basically 15.3% of that bottom line number. So what you do when you become an S corporation, you split the roles so that you're an employee on a W-2, can't get away from the payroll tax on that, but you're a business owner on your distributions and whatever else is left in net income, and that is not subject to FICA. And so over here, say you were, making $100,000 bottom line as a Schedule C, you were paying or you're paying $15,300 in payroll tax, self-employment tax. Here, maybe you pay yourself $30,000 on the W-2. That's only $4,500. That other 70 isn't subject to payroll tax. So that's over $10,000 of savings. But what I see guys do a lot of times is they'll elect S corp status, and then they'll pay this same 100,000 to themselves on a W-2, and they'll try to basically end up zero on the profit and loss for the company. If you do that, you're getting no benefit at all, and in fact, it's costing you more money because you're running payroll when you don't need to be. The other thing that I'm seeing is they'll do no W-2 at all and just take everything out in distribution. So that becomes an IRS problem where if you get caught doing that, the IRS is going to say you're not paying yourself a reasonable compensation, and they're going to recharacterize all your distributions as subject to payroll tax as wages. Now, the IRS has won court cases on this if you go zero W-2 and everything else distribution, but they haven't won a court case on, well, what exactly is reasonable compensation? Is it minimum wage? Is it $30,000 salary? Is it $60,000 salary? They've never won a court case on that. So you can be aggressive over here, but you got to pay yourself something, or else you're going to end up in a mess.